Thank you so much, Victory, for joining me today.
Thanks for having me, Petroleum. Good morning.
Good morning to you too. Now, the equities market has been very bearish this month, with the offshore index settling at minus 1.88 month to date. You might want to call that 1.9%, minus 1.9%. Does that align with your expectations?
Well, yeah, thanks for having me. So the equities market has really been volatile. I'm looking at market activities even from the beginning of the year. Well, we saw gains in January, February, amid those volatilities, and even comparing it to the same period in 2024, as of January, the market had already done around 35% in January 2024. So the sentiment is a lot more weaker in this year, and we largely expected this, given our outlook from the beginning of the year, where we mentioned that we'll continue to see, some sort of bearish sentiments, mixed to bearish sentiments, especially in the first quarter of the year, given the macroeconomic backdrop and investors being, more cautious towards equities assets. But it hasn't felt so bad. We're seeing that we saw January and February recording positive returns. But for this month, it's been more to the bearish side. And I would attribute it largely to slower or weaker investors' confidence towards equities assets, more cautious trading approach from investors. Also, saying the fact that investors are still trying to digest a lot of the macroeconomic variables, inflation numbers coming in, looking at the FX situation and all that. So it's been more of mixed sentiment, mixed to bearish sentiment, and we expect that to still play in going forward, for a couple of weeks going forward. Even judging from the technical indicators, of the market, looking at support levels currently at around 102,000, 103,000 for the ASI. So will market participants, allow the market still decline to these levels? We'll just wait and see. But seeing that the market hits, the ASI hits around 109,000 points in mid-February, those pullbacks have always been anticipated. So the question on everybody's lips now is, when are we going to be seeing, a more positive bias or a retracement, of these pullbacks?
So I think you should answer that question then. When are we going to see that happen?
Well, currently, like I mentioned earlier, I will just attribute the current sentiments that we're seeing, the lackluster sentiment that we're seeing currently, to lack of confidence in the markets. Because from the macroeconomics, we should have been seeing pockets of stronger appetite for equities. I'm saying that inflationary pressure, has eased, looking at the numbers, the lower numbers, and with the recent figures that came out, also the FX market, we've seen that stability from the beginning of the year. And looking at interest rates, a less hawkish or less accommodative stance from the Monetary Policy Committee. So this put together should have spurred a more positive bias to the equities market, and also considering the earnings releases that we've seen come to the market, quite some impressive numbers from across sectors. So that should have by now been spurring positive sentiments towards the market, but we've not seen that happening over the past few weeks. So from our expectations, we expect that investors would react more favorably, possibly when we start to see Q1 numbers coming in. Because for a lot of the players in the real sector, we've seen signs of improvement, especially in their fourth quarter 2024 earnings. We've seen stronger recovery in some of these players, and we expect that the current macroeconomic backdrop would play into the figures we'll be seeing in their earnings for 2025. And from Q1, we'll start to see that stronger investor sentiment towards players in the real sector, especially. So that should be a catalyst for gains in the equities markets, a more positive return for the ASI.
All right, that's quite interesting. I mean, some persons are saying investors are taking out funds. And for me, I'm looking at it and I say to myself, maybe day traders are just having a nice time. They do bargain hunting, and when it gets to a point, maybe a target price or what have you, they then sell off to make money. I think that's what's happening. I don't know about you. But of course, away from that, let's take a look at the month-to-date performance. And looking at that, all indices, I mean, all the indexes that we're tracking are in the red. And we see that banking and insurance sectors are the worst hit. Now, that is followed by consumer goods, which is down 2.06%, oil and gas down 1.53%. And of course, we also have the industrial goods, which is down 22 basis points. Help us unpack this. I mean, how should investors look at all of these?
Well, it still boils down to the broader market sentiment. For a lot of these indices, sectors in this, tickers in some of these sectors really have rallied. We've seen quite significant appreciation bias even coming from the previous year. For a sector like oil and gas, you saw consecutive years, 2023, 2024, of the oil and gas sector, realizing the highest gains across the other sectors in the market. Also, the financial services, banking and insurance, doing quite well in the previous year. So those pullbacks were very much anticipated, especially on stocks that have realized very significant gains. So it's just basically investors, taking profits on some of these tickers. And, there's so much uncertainty, even towards equity assets, even looking at what is going on in the global space as well. Bearish bias, with the cases of the tariff wars and all that, casting a shadow on the equities market. So both in the global space and domestic space, it's basically more the same story. But we expect, stronger confidence in the markets going forward, especially when there's more direction, with fiscal policies in the global space and also in the domestic space as well. So across sectors, just basically investors, buckets of profit-taking activities, outweighing the buying interest. And for some tickers that are fundamentally strong and have shed weight over the past few weeks, especially some tickers in the banking sector, like Access Core, also some players in the insurance space, ICO, down to the telcos, MTN, and some other very fundamentally sound tickers. And we expect bargain hunting in coming weeks on these tickers, especially the ones that have substantial upside. And for tickers that will be strong dividend paying tickers, especially for the banking sector, when their audited results start to come to the market and we see dividend declarations, now we expect that will spur a positive bias, for the equities markets. But for now, we'll continue to see, more of the mixed sentiments, the bulls and the bears, trying to dominate each other. So we just expect that to keep playing in, especially, across key sectors that have realized stronger gains, from the beginning of the year or from the past year.
All right, let's stay a bit on oil and gas. Stocks in the downstream sector have sort of plummeted irrespective of strong earnings. Apart from Etana, which has gained over 56% year to date in its share price, others, in the downstream sector, have in fact retreated. Is this market correction profit-taking, or you think it's tied to the price wars or the cut on the price of premium motor spirits by Dangote Refinery?
Well, it's quite a combination of factors. For the oil and gas space, like I mentioned earlier, we saw very strong performance last year and even in the preceding year. So those pullbacks were always imminent. For players like Total, MRS, Con Oil, it's just basically, investors capitalizing their profits, amid the uncertainties, going on in the industry, especially around price discovery for PMS, amongst other macroeconomic factors. But the outlook is still, quite bright for the oil and gas sector. Considering the fundamentals, considering the policies that have been put in place, the measures that have been put in place to, optimize the activities of the oil and gas sector. Those pullbacks, I would say, are just very much temporary. And even looking at the broad markets, for every time we've seen, even historically, every time that we've seen pullbacks in the market or the bearish sentiments in the market, it always gives way to the bulls. So it's just a matter of when are we going to be seeing those strong gains, and how should investors position to take advantage, of the positive sentiments that would hit the markets quite soon.
But I still want to go back to one of the parts of the question where I talked about, whether it has anything to do with the, changing price of premium motor spirits, specifically because we're looking at the downstream sector. Oando is there. Oando shouldn't be on that list, but of course it's there just because I wanted to show a difference in year-to-date performance. So talk to us. Is it connected to price of PMS, and if that is the case, will it continue to affect investor sentiment? Because investors are probably going to say this is going to impact the revenue, because the higher the price, the more revenue. And now we've also seen that these downstream oil and gas sectors have also reduced their projections for 2025 in terms of earnings. So speak to that.
Well, yeah. So for the price wars, we expect to see some impact, on the earnings for players in the downstream sector, especially with lower PMS prices, and even looking at in the global space, what oil prices are doing currently. We've seen lower crude oil prices with Brent. I think Brent's printing at around $69 per barrel as of last week. So we expect that to filter into domestic prices, and also with the lower prices that we've been seeing, especially from with Dangote refinery on board, and lower prices from Dangote also influencing other prices in the markets to also sell lower. So that in itself is a kind of it dampens the outlook for how much the downstream players can up their revenue figures. On the part of consumers, it's quite favorable. Lower PMS prices, which should ultimately translate into lower transportation costs, and ease prices. So, generally, we do not see so much of a significant impact, on the performance of players in the downstream sector. But investors, as always, would always react to, whatever is going on within the sector, and how this is going to, impact their holdings, especially across the sectors. So, we still see that there's still a significant. We still expect significant upside, on some of the players in the downstream sector, especially for a player like Corn Oil and also Total. From our estimates, we expect those players to see significant price appreciation before the end of the year. So the outlook is still positive for some of the players in the downstream sector, based on their ability to drive to better manage the operating costs. Why not necessarily stretching their revenue lines. So more of the value will come from their ability to manage the operating costs, and also beat down on some of the impact of the macroeconomic space. It still boils as what I said earlier about the macroeconomic backdrop being more favorable for some of these players. So on the balance of factors, our outlook is still very much positive for some of the takers in the downstream oil and gas space.
Right, I would have asked you what you think should be the playbook for investors, but just so that we don't miss out on this, I mean, I'm being curious here, looking at the Petroleum Retail Owners Association of Nigeria voicing frustration over falling prices and warning of potential layoffs and economic instability. Is this truly a challenge, or it's clearly overstated? I mean, I'm taking us away from the markets into the real economy now.
Okay, well, there are two angles to look at this. I mean, on one hand, falling prices, falling fuel prices, like I mentioned earlier, is quite favorable for consumers. I mean, it's something that has been quite a headache. Elevated PMS prices, which are filtered into inflationary pressure due to the high transportation costs, and all that. But on the part of the marketers, looking at the fact that they have to stay profitable from their businesses, and seeing that with the current prices of PMS, especially from Dangote, selling at lower prices, and also influencing, other players in the market. But looking at, the landing cost of petrol, and all that, and, markup price for the marketers, at current prices, their profit margins are very much minimal. And even looking at, landing cost being at around 900, still doesn't guarantee profitability for most of the marketers. So prices being at around falling to around 800 and lower, is going to really much impact the profitability for the petrol marketers. So and that is where their complaints is very much coming from, as to how they'll be able to sustain their cost lines, paying of their staff, and also being able to have substantial net income at the end of the day. So I mean the dynamics, there's still a lot that is dicey about it, but we'll still continue to watch and see how this all plays out. But currently, with the current backdrop, we might continue to see prices, PMS prices continue to stay at this level, or fluctuate between fluctuate between these levels or a bit higher or lower. But it's going to be determined by what plays out in the international market for crude, and also the FX markets, the stability in the FX markets, or how the depreciation is going to impact prices, retail prices. So the deciding factor,
all right, Victory.
Global factor.
Thank you so much, Victory. I understand there is a lot to say, but we just have to go here. We have a commercial. Thank you so much for joining us on the show and for sharing your thoughts with us.